What's up? In this video, I'm going to cover what is a corporation, shares, and a board of directors. And if we're just meeting, I'm Casey, an accountant at a Fortune 200 company. And my goal is to make accounting a little bit more easier to learn. So what exactly is a corporation? A corporation is owned by one or more individuals, and they're called shareholders. And these shareholders own shares, which essentially are units of ownership within the corporation. For example, imagine that Blue Yoga Corporation has 1,000 shares. One shareholder might own 300 shares, another might own 250, another 200, and finally the last one 250. The number of shares that you own determines how much of the corporation you own. Pretty straightforward, right? Now, shares are usually divided into common shares and preferred shares. If there's only one type of shares, it's typically going to be common shares. And the key difference is you can vote with common shares, and typically you can't with preferred. And preferred shareholders, they get paid out first in the event of that the corporation goes bankrupt. Now, something most people don't know is that shares can be held in a private organization, but typically we're going to talk about shares held in a public organization on this channel. And a public organization is one that is traded on something that is traded on like the stock exchange. And remember that you can buy shares of a publicly traded company. Now, a huge key difference between sole proprietorships, partnerships, and a corporation is how the corporation files its tax return. The corporation is it's its own legal entity, which means it files its own tax return. For example, if Purple Yoga Company is a publicly traded company, it files its own tax return. And a strong positive of a corporation is that the shareholders are subject to limited liability. So what does that mean? Okay, in the event of a bankruptcy, if that company owes money, the shareholders do not have to pay. What they would lose is only their initial investment. So let's march through an example. Say you invested $200 into Ulta Beauty Company, and Ulta Beauty went under. They're not going to come for you personally, but you would lose out on your initial investment. Now, to frame it in a positive way, let's say Ulta Beauty Company is doing great and you own 200 shares and they pay $1 per dividend each quarter. You would make $200 a quarter. And as a shareholder in a larger corporation, you are not going to be involved in the day-to-day operations of that corporation. Instead, as a common shareholder, you will participate indirectly by electing a board of directors. Note that the board of directors represents you, the shareholder, and is responsible for overseeing the corporation's big picture direction. And another thing to note is that the board doesn't manage daily operations. That job is delegated to the officers of the corporation. So I want you to think of somebody like the VP of Finance, Vice President of Technology, Vice President of Human Resource, and trickling down the ladder. So note that shareholders typically meet annually to elect the board of directors, annually meaning once a year. The board of directors typically meet quarterly or 4 times a year to review how the company is doing, i.e., is the company making money or is the company losing money? And unlike you, the shareholder, the board of directors is personally liable if the company fails due to negligence or misconduct. For example, if the company makes a huge mistake, everybody on the board of directors could be fined and fired. And if you want to learn a little bit more about accounting basics, purchase my short ebook off of Amazon.